So, why is the trade closing disclosure allowed to be examined on or before closing? Is it to allow the buyer to see cost at or before closing to see if they can get the loan at a cheaper price? Is it to check for mathematical errors and ask the lender questions? Is it to provide for special fees to specific parties for business related to the real estate transaction? Or is it to make sure the title insurance came from the right company? What do you guys think? What's that TRID disclosure all about? And the TRID disclosure is to let us know where all of our money is going at that closing table. So it's going to be important that they have this be available so that we can check for mathematical errors and ask the lender questions if we have any. Next question up. Which of the following determines the loan to value ratio on a mortgage? The mortgage loan amount as a percentage of the insured value, the loan amount as a percentage of the sales price or appraised value, whichever is the highest, the monthly payments as a percentage of the remaining balance of the loan, or the loan amount as a percentage of the sales price or appraised value, whichever is the lowest. So think about this one. We're trying to determine the loan to value ratio on a mortgage. The loan amount as a percentage of the sales price or approved value, whichever is highest or whichever is lowest. What would the lender use to determine the loan to value ratio here? And it's going to be D. It's going to be the loan amount as the percentage of the sales price or appraised value, whichever is the lowest. Remember that the lender is always going to be careful. He does not want to loan more than the value of the property. So if the appraised value comes in lower than the contract or sales price, the lender would base the loan and the loan to value ratio off of that lower amount. But if the appraiser comes in higher than the contract price, then they would base it off the lower number, the contract price. The lender is always going to play it safe when it comes to loan to value ratio. Okay. So next question. When the term beneficiary statement is used by those in a real estate finance, it identifies a statement made. Is it designating the one who will receive the property in the event of the borrower's death? Is it by the lender as to the current balance due to pay off a real estate loan? Is it by the insurer stating the amount that we pay to the policyholder if the improvements are destroyed? Or is it by the property owner listing the beneficial features of an assumable loan? What is beneficiary statement all about? And what we need to remember on beneficiary statements is that it's talking about the current payoff of the loan. We hear that term beneficiary, we might go to like A because we're thinking that person's the beneficiary if the person dies. But nope, this is the payoff statement. This is showing what we owe on this loan at this time. And that's what the beneficiary statement means. Next question up. The finance charges recorded on the truth in lending statements would include all of the following except. Is it discount points and service fees? Is it loan fees charged by the lender? Is it recording fees and title insurance premiums? Or insurance premiums for mortgage insurance payments? So what would be the finance charges that were recorded on the truth in lending statement? So let's think about this. Well, let's go through them one more time. Discount points and service fees, those would be included. Loan charges charged by the seller, definitely included. We need to know about those truth in lending statements. We need to know about that. Recording fees and title insurance premiums. Insurance premiums for mortgage insurance payment. So why did I pick C? And because those are considered legal fees, not financing fees, and they're not part of the truth in lending statement. The truth in lending statement is there to show us how much this loan is truly costing us, not the extra things like recording at the courthouse or title insurance that we might want to buy to ensure that the title is clean. Those things are different than the actual things that show up on the truth in lending statements, which is focused on just the loan. All right, next question. The secondary mortgage market is the market in which promissory notes are exchanged. Which of the following is not considered a major player in the secondary mortgage market? Now, remember the secondary mortgage market, big players. They are, let's see. Fannie Mae is definitely one. Ginnie Mae is one. Freddie Mac is one. What about old Sallie Mae here? Sallie Mae is not a major player in the secondary mortgage market. Remember, the secondary mortgage market is important because the home loans that the lenders are making are packaged up and resold to investors, or that they can restock their coffers. If I went to the bank and I said, hey, I'd like to take out a loan, and they say, oh, sorry, we just ran out of money. We loaned all of the money to your friends and neighbors that we had available. You would go, what's going on with this bank, right? So a lender cannot keep and service every single loan that they make. Some of them are sold on the secondary market, and the major players, of course, are Fannie Mae, Ginnie Mae, and Freddie Mac. All right, what is our next question? Which of the following defines a mortgage loan? Is it an instrument that is used only in the exchange of real property? Is it a loan collateralized with real estate? Is it a promissory note that is unpaid? Or is it a financial obligation which is unsecured but is used to buy a building? What do you think? The financial obligation which is unsecured would not be a mortgage loan because it would be secured by the collateral, which is the building, right? So that one's wrong. A promissory note that is unpaid, that could be anything. We could have a promissory note on various things, car, home, whatever. So the best answer here is a loan collateralized with real estate. What does collateral mean? It means the thing that's backing up that lender. It's the thing that's the security for the lender. So if the lender is making a loan on real estate, we often refer to that as a mortgage loan. Okay. And what happens if we don't pay the mortgage loan and to that collateral, then the lender would take it, sell it, and get their money back, we hope, right? And so that's the idea. Next question up. The difference between the value of a property and the total amount of liens against it is known as, is it actual cash value? Is it equity? Is it collateral, or is it a down payment? The value of the property and the total amount of liens against it. The difference between what we owe and what the value is. What do we call that? Actual cash value, equity, collateral, or a down payment? And of course, that's our equity. And we hope that after we buy real estate, that the property gains in value or that we pay it down and we gain equity, right? That's a move in a positive direction. It's the difference between what we owe and what the value of the house is, what it would sell for. All right, our next question. The Real Estate Settlement Procedures Act, RESPA, applies to which activity? Is it a lender putting a loan together for an investor buying a shopping center? Is it a broker selling a 10-unit apartment? Is it savings and loans institutions lending money for home loans to first-time buyers? Or is it licensed brokers listing and selling commercial and industrial properties? What do you guys think? RESPA, the Real Estate Settlement Procedures Act, which one does it apply to? So let's go through these one more time. A lender putting a loan together for an investor to buy a shopping center. Now, does that sound like residential? Because remember, RESPA deals with residential loans. A shopping center would definitely be a commercial loan. A broker selling a 10-unit apartment building sounds like the 10-unit is commercial as well, right? 4 units or under for residential loans, and this is 10. That won't work. Savings and loan institution lending money for home loans to first-time buyers definitely sounds like that's a winner. Or licensed brokers selling commercial industrial properties. Remember, the other 3 of these have to do with commercial or industrial properties, and this one has to do with residential, and that's what RESPA applies to. We want to focus on that for RESPA. The clause in a trust deed or mortgage that permits the lender to declare the entire unpaid balance immediately due and payable upon default is what? Is it the escalator clause, the forfeiture clause, the acceleration clause, or the judgment clause? When they're saying, hey, we know you have 20 years left on this loan, but we want you to pay it right this second. We're calling it due now because you did something, you broke our rule, right? And that would be the acceleration clause. Think of it as if I'm driving a car and I hit the gas and I speed up, I'm accelerating, right? So that acceleration clause is important because it protects the lender. If we break the agreement with them, then they could call the whole loan due at once, speed everything up and say, hey, we want to get paid now. We're not going to keep playing around with you. We're accelerating this loan. Our next question. When obtaining a mortgage loan, the buyer often has to pay discount points. These points are a percentage of what? Is it the selling price minus the agent's commission? Is it the selling price of the property? Is it the loan amount plus the closing cost? Or is it the loan amount? What are points a percentage of? And we know that points are a percentage of the loan amount, but what percentage of the loan amount? Each discount points cost the borrower 1% of the loan amount. Don't forget that formula. That's super important. Each discount point costs the borrower 1% of the loan amount, not the purchase price. Be careful with points questions because they may show up in your finance section on your test, or they might also show up in the math portion or calculations portion of your test. So the party who usually pays the loan origination fee on an FHA or Federal Housing Administration loan is the who. Who usually pays the loan origination fee on a Federal Housing Administration, also known as AKA FHA, right? Who pays that fee usually? And it's usually the borrower because he's the one borrowing the money. He's buying the house, he's borrowing the money. So this loan origination fee is usually a cost and expense that he faces. Now, what is a loan origination fee? And the loan origination fee, I always tell people, is kind of like the fee that the lender charges to put the loan together, to do the paperwork, to do the legwork, to put the time in, to get things ready for the loan to close. That's the loan origination fee. And it's part of our closing costs many times on a deal. The right to pay off a debt and reclaim property after mortgage default is called, is it reversion? Is it redemption? Is it recapture? Or is it remainder? And the truth of the matter here is that that is our right of redemption. If we get into mortgage default and we want to redeem the property, get that loan back on track, that is called the right of redemption. Now, there's a couple different terms that go along with this right of redemption. First one we need to know is that we have the equitable right of redemption when we're trying. I always tell people to think of we're trying to save the equity in the house. We're trying to get the house out of foreclosure, get things back on track before the actual auction hits. Then in some states, not all, we also have a statutory right of redemption period, and that is the period of time after the foreclosure has happened when the state allows the borrower to come back, pay off everything, get everything caught up, and get their property out of that situation, even after the auction has already occurred. Some states allow this and some states don't.